On September 15th, 2008, the world watched in disbelief as Lehman Brothers, one of the most storied and respected investment banks in American history, declared bankruptcy. This moment would soon be recognized as the tipping point that unleashed the full force of the global financial crisis, sending shockwaves through financial markets and economies around the world. Lehman Brothers, founded in 1850, had survived wars, depressions, and countless market cycles. For over a century and a half, it stood as a symbol of Wall Street's power and resilience. But in the years leading up to 2008, the bank, like many of its peers, had become deeply entangled in the world of subprime mortgages and complex financial instruments. These risky bets, fueled by easy credit and a belief that housing prices would never fall, left Lehman dangerously exposed when the housing bubble finally burst. As the summer of 2008 faded into fall, the cracks in the financial system widened. Lehman's stock price plummeted, and rumors of its insolvency spread rapidly. Executives scrambled to find a lifeline, searching for buyers, negotiating with regulators, and hoping for a government bailout that never came. Over a tense weekend in mid-September, as negotiations failed and hope dwindled, the decision was made. Lehman Brothers would file for bankruptcy protection. The news broke early Monday morning. Employees arrived at the headquarters in New York, some greeted by television cameras, others by the grim task of packing up their belongings. The iconic Lehman Brothers sign, once a beacon of financial might, now stood as a symbol of collapse and uncertainty. The bankruptcy filing was the largest in U.S. history, involving over $600 billion in assets. The immediate aftermath was chaos. Global stock markets plunged, credit markets froze, and panic spread from Wall Street to Main Street. Banks stopped lending to each other, fearing who might be next to fall. Businesses struggled to access credit, and ordinary people watched as their savings and investments evaporated. Lehman's fall exposed the fragility of the global financial system and the dangers of unchecked risk-taking. It forced governments and central banks to take unprecedented actions to stabilize markets and restore confidence. The repercussions would be felt for years, shaping economic policy, regulation, and the lives of millions. The collapse of Lehman Brothers was more than just the end of a bank. It was a turning point in modern financial history, a stark reminder of how interconnected and vulnerable our world had become. The collapse of major banks sent shockwaves through the global financial system, triggering a domino effect that would touch nearly every corner of the world. It began with the sudden and dramatic failure of institutions that, for decades, had been considered pillars of stability and trust. As the news broke, the world watched in disbelief as the doors of once mighty banks were shuttered, their employees carrying boxes of personal belongings out into the uncertain streets. For many, the first sign of trouble was the sight of long lines forming outside ATMs and bank branches. Customers, gripped by fear and uncertainty, rushed to withdraw their savings, desperate to secure what little they could before it was too late. Newspapers and television screens were filled with alarming headlines, each more dire than the last, as the reality of the crisis began to sink in. Stock markets, which had seemed unstoppable just months before, plunged with breathtaking speed. Red arrows and plummeting numbers dominated financial news tickers, erasing years of growth in a matter of days. Investors, both large and small, watched helplessly as their portfolios shrank, retirement savings evaporated, and the value of their homes and businesses tumbled. But the impact of the collapse was not limited to the world of finance. In homes across the globe, families gathered around kitchen tables, reviewing bills and bank statements with growing anxiety. Parents struggled to explain the situation to their children, who overheard worried conversations and sensed the tension in the air. The loss of jobs and savings was not just a matter of numbers on a screen. It was a deeply personal crisis that threatened the security and well-being of millions. Governments, caught off guard by the speed and scale of the disaster, scrambled to respond. Emergency meetings were convened in capitals around the world as leaders sought to reassure the public and prevent further panic. Late-night press conferences became a regular occurrence, with officials announcing new measures to stabilize the markets and protect depositors. Central banks slashed interest rates, injected billions of dollars into the financial system, and coordinated unprecedented rescue packages in an effort to stem the tide. Despite these efforts, the sense of uncertainty persisted. Businesses, facing a sudden loss of credit and collapsing demand, were forced to lay off workers or close their doors entirely. Unemployment soared, and the ripple effects spread through every sector of the economy. From small, family-owned shops to multinational corporations, no one was immune to the fallout. The crisis also exposed deep flaws in the global financial system. Questions were raised about the risks that had been taken, the lack of oversight, and the complex web of interconnections that allowed the failure of a few institutions to threaten the entire economy. Regulators and policymakers faced intense scrutiny as the public demanded answers and accountability. As the weeks turned into months, the world began to grapple with the long-term consequences of the collapse. Communities came together to support those who had lost their jobs or homes, while charities and social services struggled to keep up with the growing need. The crisis forced a reckoning with the values and priorities that had shaped the financial system and sparked a global conversation about how to build a more resilient and equitable future. In the end, the domino effect of the bank collapses was a stark reminder of how interconnected our world has become. The actions of a few could set off a chain reaction that reverberated across continents, affecting the lives of millions. It was a lesson in the fragility of trust, the importance of oversight, and the need for collective action in the face of crisis. As governments, businesses, and individuals worked to rebuild, the memory of those dark days served as both a warning and a call to action. The world had been changed, perhaps forever, by the events that unfolded in the wake of the financial collapse. And while the road to recovery would be long and difficult, the experience left an indelible mark on the collective consciousness, a reminder that in a globalized world, the fate of one is often tied to the fate of all. The fall of Lehman Brothers in September 2008 was more than just the collapse of a single storied investment bank. It was a seismic event that sent shock waves through the global financial system, exposing vulnerabilities that had been quietly building for years beneath the surface of apparent prosperity. For decades, major banks and corporations had engaged in increasingly risky behavior, driven by the pursuit of ever higher profits and emboldened by a belief that the system was too big, too interconnected, and too important to fail. Lehman Brothers, with its 158-year history, was a symbol of Wall Street's power and prestige. Yet behind the marble facades and bustling trading floors, the bank had become deeply entangled in complex financial products, especially mortgage-backed securities and derivatives that few truly understood. As the U.S. housing market began to unravel, The value of these assets plummeted, leaving Lehman and many of its peers dangerously exposed. In the months leading up to the collapse, warning signs flashed across the financial landscape. Credit markets tightened, banks grew wary of lending to one another, and the value of mortgage-related assets continued to fall. Yet many in the industry and in government clung to the hope that the storm would pass, that the system's sheer size and sophistication would provide a buffer against disaster. But on September 15th, 2008, that illusion was shattered. Lehman Brothers filed for bankruptcy, marking the largest bankruptcy in US history. The news sent markets into freefall. Investors around the world scrambled to assess the damage, and panic spread as it became clear that no institution, no matter how vulnerable, was immune to the consequences of reckless risk-taking. The collapse exposed the fragility of the modern financial system in stark terms. It revealed how interconnected banks and corporations had become, with complex webs of debt and obligation tying them together in ways that few regulators or executives fully understood. When one major player fell, the effects rippled outward, threatening the stability of the entire global economy. Ordinary people felt the impact almost immediately. Stock markets plunged, wiping out trillions of dollars in wealth. Retirement accounts and college savings plans shrank overnight. Businesses struggled to secure loans, leading to layoffs and shuttered factories. Homeowners faced foreclosure as the value of their properties plummeted. The sense of security that had defined the previous decade evaporated, replaced by uncertainty and fear. In the aftermath, governments and central banks around the world scrambled to contain the damage. Emergency meetings were held, bailout packages were assembled, and new regulations were proposed in an effort to restore confidence and prevent a complete collapse. Yet, the scars of the crisis would linger for years, shaping the economic and political landscape in profound ways. The fall of Lehman Brothers was a wake-up call, a stark reminder that unchecked risk-taking, lack of transparency, and overconfidence in the resilience of financial institutions can have devastating consequences. It forced policymakers, business leaders, and ordinary citizens alike to confront uncomfortable truths about the vulnerabilities of the system they had come to rely on. In the years since, debates have raged over what went wrong and how to prevent a similar disaster in the future. Some argued that the crisis was the inevitable result of a culture that prioritized short-term gains over long-term stability. Others point to regulatory failures, inadequate oversight, and the rise of financial instruments that were poorly understood and poorly managed. What is clear, however, is that the collapse of Lehman Brothers exposed the fragility of a system that many believed to be unbreakable. It showed that when major banks and corporations take reckless risks, the consequences can reverberate far beyond Wall Street, threatening the livelihoods and futures of people around the world. The lessons of 2008 continue to resonate, serving as both a warning and a call to action for those who would build a more stable and resilient financial system. Today, the Lehman Brothers lesson remains a stark warning about greed, mismanagement, and the importance of financial oversight and regulation.